My name is Thomas O'Regan and I'm a professional property investor here in Australia. Now today I just wanted to take you through a few investment mistakes which I either have or have not made myself. And that first one is thinking that houses go up more than units. Now we're getting to the point where if you want to invest in a property or if you want to grow wealth through property, it's kind of getting to the point now where most people can only afford a unit to get started. Okay, so if you can only afford a unit to get started, that doesn't mean you shouldn't start. That 100% means you should just start with what you can afford. And if that's a unit, that's fine. Because the reality is the properties that I've owned that have grown the most are actually units. And from an investment perspective, the numbers usually stack up better for units than they do for houses. And that's why the actual majority of my property portfolio is made up of units. Now, people think houses grow more than units, which can be true depending on how you look at it, but there's a funny thing in the property market and the way properties go up in value, and it's like this. It's like they go up, they go flat, sometimes they go backwards, and then all of a sudden they just go up very fast, very quick, and it's crazy, right? But basically, what is happening there is a property market cycle. And if you understand how to read property market cycles, you can buy properties, units or houses at the start of a property market cycle, and they will go through a substantial amount of capital growth in a short period of time, right? So it doesn't matter if you bought a unit or a house. If you buy a property at the start of a market cycle and it doubles or triples or quadruples in a space of 2 to 5 years, then who cares if it's a unit or a house, okay? What you really need to be focusing on is my property portfolio cash flowing and supporting itself through the rental income as a whole? And if so, or if not, then what am I doing to de-risk myself if I was to lose my job? That's what I always think anyway. Now, a few other mistakes that I really want to point out is that I haven't done myself, but never buy properties off the plan, okay? And I guess that in itself isn't the issue, but I would dive a bit deeper on that and say never buy properties as investments if you are going too far away from what the fundamentals of investing are, okay? So what does that mean? What does that mean? So basically that means, for example, if you are buying an investment property and it has a land component, never spend too far away from whatever that land component is plus the building cost. If at all possible, try and buy that investment as close to the land cost as possible, right? So it may seem really crazy if you don't really know how to value properties, if you don't know how to value investments, but there is so many investment properties out there that you are simply buying a house for free with the land that has got land on it, and you are paying the land value for the house and the property as a whole. There's plenty of deals out there like that. It might be, not to get too confusing, it might be like a warehouse and the land value is worth $1 million and the warehouse, it could be worth $100,000 or $200,000 or $500,000, doesn't matter, but they're selling it for $1 million, and these things happen all the time. Or it could be a house and the land component is $500,000 and they're selling it for $550,000, pretty close to the land value. Okay, that's what a good investment looks like. Now, I would say that works for apartments as well. Say, for example, if you're looking at an apartment, it's on a very large piece of land, say 2,000 square meters, just for the example, and you buy one of 8 apartments, and you have a substantial land component in a premium area. The actual land component could be worth more than you're paying for the property itself. So it doesn't matter what property it is, but generally if you're ever looking at a property that is off the plan, it will be so far away from these fundamentals that it's ridiculous and it's not a good investment, because typically the person that has built the off the plan property is looking to make as much profit as they can, and they are paying sales agents, and they've paid the land cost, and they've paid the building costs and the material costs, and they've held the loan for such a long time, and they have to make a huge profit, or they have to make a huge amount of money in order to profit. And what it is ultimately going to mean for the end user, you, the purchaser, is you're paying far in excess over what the market value or what the actual intrinsic value is of that property. Okay, and something that might be something like, okay, the actual underlying land component of the property, the off the land property, is worth, say, $500,000, and you're paying $3.5 million for this property. That's what not sound investing looks like. If I'm paying 10 times, 5 times, 5 or 10 times, or however many times over the intrinsic value of the property, meaning that the cost of the building plus the land, then I don't want to invest in it unless there's some seriously compelling rental income or yield attached to that property, and then even I would be questioning that. So don't buy off the plan, guys. Stick to investment fundamentals. And going into the third mistake here, and it is focusing too much on capital growth. Now, capital growth is absolutely amazing, but what happens when you don't get capital growth and it is all you focus on is you put your property investment portfolio in the grave. That means you kill your investment property portfolio, you kill the growth and the progression of your investment property portfolio. What do I mean? I mean, if you focus on capital growth so much that you are likely to purchase a property that is so negative cash flow that it is costing you an arm and a leg to hold this thing, because you are hoping that it's going to get capital growth because it's in the best blue chip area ever, that is a very risky position to be in, because not only will it be depressing to take it to a market downturn because the property price may be going backwards, the property price is going backwards, and it may be costing you an arm and a leg to watch it go backwards. I can't imagine anything worse than that, right? So I would say, if you're investing, look at maintaining a neutral to positive cash flow, or even a highly positive cash flow, because especially in a market downturn, that's when real investors make the majority of their money. I'm not talking about mum and dad investors here. I'm talking about real investors that create real wealth through investing in property. Most of them make their big money in market downturns, and that is because they've positioned themselves through cash flow and managing their funds in a way so that they can continuously acquire these discount properties when the market is having a downturn. Now, me personally, I like to keep my my property portfolio neutral to positive cash flow. So that way, every property I acquire, it goes from either neutral to positive cash flow and excessive positive cash flow very quickly. And if it goes through a market downturn, and I'm not stressed because the property is generating enough rental income for me, for it to look after itself. And then obviously, if you lose your job, worst case scenario, you don't have to sell your property portfolio because it looks after itself. And one of the worst things you can do is sell a property portfolio in a market downturn, because you're going to lose money. You're going to lose money, right? You're going to lose money, and to be in a property market downturn and not be able to acquire properties is kind of a sad thing, because that's when the most opportunity is there. So if you're negative cash flow, market downturn, you're going to be stuck. You're going to miss all the opportunities. Don't do it. See you guys next time. Bye.